Bring my friend Frank Ellerbroek onto the program. Frank is with Evergreen Home Loans. His specialty has really been mortgage planning. He, over the years, Frank and I, years and years and years ago, probably getting close to 20 years ago, we had a mastermind and we'd get together once a week and just really had a good time learning from one another. He's been kind of a long-term staple in this industry locally, somebody I've referred a lot of people to over the years. And part of the reason for that is I know that when I send people to Frank, he's going to do a good job for them. And the answer is not always that they need to get a mortgage. So he'll point them in the right direction. But Frank, appreciate you being a guest on Sound Retirement Radio this morning. Thanks for coming back to talk to us.
Look forward to it. Thanks for having me, Jason.
Yeah, absolutely. Frank, so the reason we're doing the show today is I've been getting a lot of calls from people saying, hey, Jason, with this whole coronavirus thing, I'm wondering, we've got a lot of equity in the house. Should we be doing a home equity line of credit and accessing some of that equity? Should we be refinancing the house, doing a cash out and capturing some of these low interest rates and increasing our cash reserves? So I want to ask you about some of those planning strategies. But before I do, I'm just kind of curious to hear from your perspective, are people still able to get mortgages in this current environment?
Absolutely. Mortgage products are still readily available. There is some tightening going on in certain mortgage products availability out there. Some of those can be construction type loans or what was called non-qualified mortgage that were kind of being a rebirth out there that were similar to almost some subprime, but they're not subprime. And these non-qualified mortgage products have pretty much gone away because there's no market for them whatsoever. The jumbo financing has also taken a little bit of a hit out there. They've really tightened up on what you can do with that jumbo financing. They're not allowing you really to go up above that 80% loan to value mark. So they want to make sure these borrowers have got great credit and along with enough equity in the property when they're lending on some of those products. But overall, with the conventional products, the government products, they're still widely available.
Okay. And then I guess the second question is, I know the bankers have kind of shifted gears to really focusing on some of these small business lending. So from your perspective with Evergreen Home Loans, because I don't think you guys are doing anything when it comes to like Paycheck Protection Program, does that mean that you guys have more ability to help people on the mortgage side than a bank would? Or how does that look for you guys?
Well, how it looks for us is we strictly deal with mortgages only. We are a mortgage bank. We service about 70-80% of our own loans here at Evergreen Home Loans, and we specialize in just doing mortgages. So where this helps us out tremendously is we use all of our resources in helping close our clients very quickly through the process. So right now, purchase transactions will typically take around 30 days, possibly out to 45 days. Refinance transactions, just because of the slowdown with appraisers and the overall marketplace, are about anywhere from 40 to 60 days, whereas banks and banking institutions right now are taking waiting lists for refinance transactions, not allowing you to lock your loan right away, making you lock your loan down the line somewhere. And they could be taking anywhere from 3 to 6 months to close a transaction, depending on the banking institution.
3 to 6 months for what kind of transaction is it taking them to close those?
It could be a conventional type loan, or it could be even a government type loan. But because of the volume levels and their ability not to be able to process these loans as quickly, and also because they want to make sure they're closing their purchase business first, which is a priority to a lot of mortgage lenders, they're taking much longer because they're not geared up to handle not only mortgage volume, but also all the other volume that they have that their bank offers.
Yeah. Well, so Frank, I guess, again, just trying to understand, a lot of people, they have a lot of their net worth tied up in the walls and foundation and roof of their home. A lot of money inside the equity of their house. And so as we go into this period of uncertainty, people are trying to figure out, well, how can I create more liquidity? How can I get more access to more money? And so I've had a lot of phone calls from people saying, Jason, is this a time, should I be pulling money out of my house? So give us your thoughts from your perspective, helping people doing the mortgage planning that you do for people. And I know you and I have worked closely over the years from a financial planning standpoint to make sure that the mortgage planning works. But is this a good time for people to be considering a cash out refinance, or should they be looking at more like a home equity line of credit, or what should they be looking for if they want some liquidity from the equity in their home?
Yeah, that really depends on every single client I work with, because everybody has different needs, as you're well aware of, especially doing financial planning, and same way in the mortgage world also. So when I'm getting a client coming in, we're asking them the questions of what they're needing that money for. Are they needing it for more reserves or cash flow potential in the future? Or are they needing it for a large project or something that they need those monies right now, and they need most of all that money availability at this point in time? Along with, what's their current interest rate on their mortgage right now? Do they have a great interest rate? And another one is, how much do they need? And so we kind of look at all those different factors with the client and make a determination that, if it makes sense to need that money up front and their rate slightly higher, or they just need that money and we can get them a little bit lower rate and the cash flow of the monthly payment works out, it could make sense to do a cash out refinance. The downside to that cash out refinance is you're going through the full mortgage process and you're paying all the fees involved with doing a mortgage. The other thing that most folks don't understand is when you're doing a cash out refinance, you're actually getting a little bit higher interest rate than you would if you were doing a rate term refinance. A rate term refinance is where you're just refinancing your current mortgage versus pulling that cash out. So we have to look at that factor also. Most of the time when we're dealing with cash flow or the ability for people to access cash in the future, a lot of times that home equity line of credit is a great option. And myself, I refer out a lot of my home equity lines of credit because that's one area where we're not specializing in as much as a bank does, but I've got some great resources for that. Whereas a home equity line of credit can be an interest-only payment. They can draw on it when they want to. They can pay down on it when they want to, so they have those funds available again. And typically those are open for a 10-year period. So that could work out really well for someone kind of concerned about possibly losing their job, where they want to access some of that equity, but they don't want it right now. Whereas that cash out refinance, you're paying that payment right out the gate, and you have that lump sum of money that's sitting in your bank account waiting to be used. So I sometimes think a home equity line of credit is much better for that situation. So it just really depends on the borrower. Both directions can make sense, but a lot of times if it's a smaller amount or they're needing that money later on, I'll recommend a home equity line of credit.
So what about, got all kinds of questions that have come up then based on that. You mentioned a cash out refinance, you pay a little bit higher interest rate than a rate term refinance. On a rate term refinance, does that mean if you had 30-year loan originally, you're down to 25 years and now you're going back to 30? Is that what you mean by a rate term refinance? You're just trying to capture a lower interest rate?
It could be several different things. Rate term refinance can mean maybe you're coming out of an ARM product into a fixed product. B, it could be you're going to lower your 30-year loan into another lower rate of a 30-year loan. Could mean that you're in a 30-year loan, want to go to a 15 or a 20-year loan. Also, I've had folks, because of the cash flow situation that's going on now, coming out of their 15-year loan because they realized they should have got into a 30 for a better cash flow situation than jumping into that 15, and they're refinancing back into 30s. The real key, what we're looking at, especially in today's times, is really cash flow. Are they prepared for something that's going to happen like what's going on with COVID-19 today? Are they prepared to be able to make that higher payment over time? And so sometimes when we're looking at these 15 versus these 30s, we're having those conversations with our clients. The other big thing that's going on the market, we can talk about that a little bit later on, is believe it or not, the secondary markets, they are pricing almost the 15 and the 20-year loans today at or worse than a 30-year loan. And what they're doing is they're really trying to drive clients into that 30-year loan, which is one of the most safest products out there. So we see some of that going on, and I expect that to shift around a little bit too. So
what you're saying then is people are paying, at one time you could get a better interest rate if you went on a 15-year term on the mortgage, but you're seeing the rates are actually coming up on those 15-year mortgages. People are paying almost more for those than they are for the 30.